We're currently at a very critical junction in the stock market. What you see here on my screen is a SPY, which is the S&P 500 index fund, which closely follows the S&P 500. And the indicator I have plotted here in this white line is AVWAP-Q. We start off my videos analyzing with AVWAP-Q, which is VWAP anchored to the beginning of each quarter. This works very well on market indexes to give you a sense of whether buyers or sellers are in control. It's very easy to read. When price is trading below AVWAP-Q, tells you that sellers are in control. That should give you a bearish short-term bias. When price breaks above AVWAP-Q, like you saw on April 9th, that tells you that buyers have gained control, which means that I'm going to be flipped to bullish in the short term, especially when we test it and hold it several times. So this week, we started off on Monday, April 21st. We started off with a gap down below AVWAP-Q, and a retest of the low that we had here before recovering it and bouncing higher. This was a fake, basically a bear trap right here. This was a fake out before another move higher, which ended the week slightly above the highs on that huge historic 10% market move day. And so why do I say we're at a critical junction? Well, a lot of my indications have been popping up saying that we have hit a market bottom, a most probable market bottom. Maybe not the market bottom, but a market bottom. And I go over them in my previous videos, but I'll quickly just skim over those studies that I was seeing. The first indicator to see potential market bottoms is when you compare the S&P 500 index fund on the weekly chart, so SPX on the weekly chart, and you plot Williams percent R in two different settings. Those two settings are a 52-day length and a 13-day length. And basically when both of these plot below -80, that signals a potential market bottom. This signaled the week of March 31st. And personally, the way I read them to be conservative is I wait for the percent R to recover back into the range at the same time. So really, I started thinking this is a market bottom the week after, Monday, April 7th, which was this green candle right here on the weekly chart. And so far, we've been seeing a market rally from this point. A quick overview of historical performance on this indicator, which I personally have tested since like the 1950s, 1940s. And I've seen it's been very reliable. Not in the sense whether it's a market bottom, but definitely in the sense that as an investor, those were objectively great places to add to your long-term investments. For example, in 2022, following this, you would have bought the dip here. You would have bought the dip here. You would have bought the dip here. And yeah, you would have DCA 3 times in 2022. And each of those times is a really good place to add to your investments. 13% discount from the all-time highs, and then a 19% discount, and then finally a 22% discount. And so regardless of whether or not this calls the market bottom, it definitely does call a certain type of market bottom, and at the least are good places to add for your investments. Another study that I saw was using the VIX to see where market bottoms happened. Now the VIX was created in the 90s, so we only have data dating back to the 1990s. But this study that I did, these were all the dates from 1998 to present time, where basically you want to see where the VIX closes above 45 at least, and then drops back below 30. And this happened a total of, I believe here is 13 times in the market history. And most of these times, as you can see, did call the market bottom, like the ultimate market bottom. And these were the percent returns of the market. So the S&P 500, 1 month, 3 months, 6 months, and 1 year. post this, not post whether it closed below 30, but actually post where the VIX made these highs here in this column. So the rows highlighted in blue show the times where the VIX went above 60, which, as you can see, has only been 4 times in history. Um, Now, when it goes above 60, those tend to have correlated with more major market drops, like in 2008 and 2020. And I have some asterisks here. So October 2008, this did not call the market bottom. The market fell another 24% before bottoming in March 2009. So you could say, well, if that's the case, then should I just not buy anything? Well, not necessarily, because 1 year after that, regardless, you're up 19% on your investments. So the point of this is not to say where you should time your entries or time your trades or pick bottoms. This is to help you make a decision as an investor, because ultimately the best way to make money in stocks is through investing. Warren Buffett, Peter Lynch, all of those legendary hedge fund managers and investors, they made money investing, right? So this shows you that when this VIX correlation triggers, you can expect a good return 1 year from this point on. Even in 2018, I mean, even a small 3% return it's a return, and you don't have to go all in here when this happens. As an investor, you always want a DCA. You want to buy in levels. So let's just say, you have I personally have 15% cash reserves left. Before that, I had 25%. When I saw this, I put another 10% cash into the market and invested it. Why do I have 15% cash left? Because there's a chance that the bottom hasn't happened yet. We could keep heading lower. But I'm positioning myself where I wouldn't be concerned about that. Where if that happens, I'm totally fine, because now I can buy the stocks I want at even cheaper prices, and I know that in the long run, I'm going to get a phenomenal return from that. That's the kind of mindset I think you should be in during this market volatility. And then finally, one last indicator that I use is a money flow index. And by the way, these are all found on TradingView. I'm not the VIX study. I did that one, and I posted it in my Discord. But these indicators I'm showing, the Williams percent R, this MFI index, like those are found in TradingView for free. You could use them yourself. And this showed a bottom. Basically, when MFI goes below 25, that signals a potential market bottom. And this works very well on the SPY, not SPX, but on the SPY. And this triggered Tuesday, April 8th. And that timing could not have been any better. I mean, if you just wait till the end of the candle close, like maybe, 10 minutes before market close, and you see that this candle and this indicator held this bottom indicator, you would have gotten a really good entry point before this big move higher. And even then, I mean, your goal shouldn't be to get the perfect entry, but let's just say you saw the big candle, have patience. These kind of moves will be tested in a market volatility. You could have invested here, or here, or here. The performance of this indicator is also very similar to the Williams percent R. Sometimes it marks the ultimate bottom, sometimes it doesn't. This marked the ultimate bottom back in August 2020, on August 5th, 2024. I mean, literally the bottom. Boom. It triggered back in May 2024. It didn't trigger on this initial move, it triggered here. So this is very reliable and accurate in my opinion to show you when a good entry point would be. Same thing back in October 2023. It didn't trigger on this dip. It didn't trigger on this dip. It triggered on this final one here before a massive, massive market run up. So anyways, my point is that through these indicators, I'm leaning towards the fact that we have seen a market bottom, potentially the market bottom. I think I'm about 65% on the side of we're going to recover back to all-time highs this year, and I am about 35% on the side that we're going to enter a bear market. And I believe we're going to see which one it is very, very soon. I'm going to go over some technical levels here. So firstly, let me turn on the moving averages. Every trader, investor should have, the major simple moving averages on their daily charts. Blue is a 50-day, purple is a 200-day, green is a 150, and gray is a 100. So we're still below all major moving averages. We're still below the 50-day moving average. So this isn't saying, gung ho and all that stuff. I'm just saying, like, as of now, we're still below all the major moving averages. And one thing I've heard recently, which I think I talked about in my last video last week, was the death cross, right? The 50-day crossing below the 200-day moving average. And the death cross has this reputation of, oh, when that happens, we're going to see more pain, more market downside. And I wanted to figure it out for myself. So I did a study on it. I posted a study in my Discord channel, and what I based off the results, I saw that there were a total of 28 death crosses since from 1960 to present day. 28. 11 of those 28 resulted in more pain, and these were the years. The other 17 times it showed up, it was actually at or near the market bottom. So in conclusion, the chances of more pain after a death cross is only 39%. That's less than 50%, aka the odds are not in your favor if you trade a death cross as seeing more downside. They're actually more in your favor of it being near or at the market bottom. So a lesson here is that it's very important that when you see stuff online, even in my videos, in anyone's videos, any studies you see online, you need to verify yourself. Check the facts. This information is public. You can go to any stock chart, any index, and you can look at historical prices from when they were, public on the stock market. So you have the tools. Get the time, sit down, look at those indicators, verify with them. Luckily for this one, I did it for you with the 50-day and 200-day moving average on the death cross, but that's a very important lesson. I just wanted to share it with you guys. Anyways, back to this. So typically when markets break down, in wave patterns, right? Wave down, wave up, wave down, and they form horizontal support levels and resistance levels, right? Support becomes resistance when it's broken below, like right here. We sold off, found support around 5,500, made a bounce, tested it, bounced, and broke below. Became resistance, and now we're starting to break above it slightly here. And with these, it's important to know that they're not like exact lines in the sand. The market is efficient, but doesn't work that efficiently. This could be up here, right? You can easily say, well, this is the support level here too. So you want to think of these as like zones of support. So we're in this zone of support. I guess I could draw like a rectangle if you really wanted to kind of show you what I mean by that. But this would be like your zone of resistance / support here, and we're in it right here. We're also broke. I think we broke out of this downtrend line that we formed on this move down so far. The important thing to note with these kind of technical analysis using these lines is that they're not perfect. And I'll show you why, right? I'll go back to 2022. I'll go to a cleaner chart. You could say in 2022, before you knew all this price action, right? Let's just say you were right here. All right, you drew this downtrend line like that. Breakout, failed. Okay, you saw that. Now you adjust your trend line like that. Okay, cool. Wow, we broke out. Oh my gosh, back to all-time highs, right? No. So they're not perfect, but they just kind of give you an idea of where price action could be going in the short term. I find these horizontal levels to be much more reliable. All right. Again, if I go back to 2022, I could say that, market sold off. We formed this bottom here. We tested it, held, again, zones, right? Zones. Held, bounced, broke below. Now it becomes resistance, now it becomes resistance here. Failed. Resistance. Break above. Test it. Continue. You know what I'm trying to say? Horizontals, technical levels, much, much more reliable. So I'm currently looking at it at this level here. If we continue breaking up here, I think the final resistance level we would see before making all-time highs would be up here at around 5,800. 5,800 on the S&P 500. Keep an eye on that. If we fail this now, like next week or two, we're going to see the move. Are we going to fill it or not? We will most likely head to a bear market. We will definitely retest this low here, 4,800. And if we fail that, then we will most likely be seeing my final target in the worst case scenario of a bear market back at SPY 400 or SPX level 4,000. All right. How did I get this level? How did I get this 35% drop target? This drop, this percentage, is the average of all bear markets in I believe in history or since 1950, one of those two. But the average of most bear markets that we've seen in the U.S. stock market. And according to that, I believe it's over 250 days from the top of the bear market to the bottom, which places the bottom of this potential bear market in October of this year. All right, this year, October, 6 months from today. So even if we consider the worst case scenario, I mean, of course, it could go lower, it could last longer, of course, but we're gonna go by the average move. So worst case scenario, going by the average, we're gonna see a 35% drop to the SPY 400 by end of October. How am I preparing for this? Again, I think you should be in either a day trading mode or investing mode. If you're a swing trader, you should only be selling put options conservatively on stocks that you want to hold for the long term and sell calls on. All right? Why? Because if we head lower, you're going to be holding and be assigned on those cash secured puts. So you want to make sure whatever positions you're holding through this market drop that we might have are going to be stocks that will recover when the market recovers eventually. So stocks like Nvidia, like Amazon, like Google, reliable companies. So, um, so yeah, this is kind of where I see the market going. I think we're at a very important inflection point. I'm seeing a lot of triggers saying that this is the market bottom and we could recover to all-time highs. I could definitely see that. I'm kind of on the side of that, but I'm positioning myself to be wrong. And if I'm wrong, then we're going to see lower prices through October of this year at SPY 400. There's one last technical indicator I like to showcase, and that's standard pivot points. This chart right here is S&P 500 index fund, so SPY, with standard pivot points, which you can easily find on TradingView and other stock charts. And the way it's read is that this white line here is a P pivot level. All right. Above it are resistance levels R1, R2, R3. Below it are support levels S1, S2, S3. S3s and R3s, the top of these ranges, are extremely strong indicators. As you can see, we hit S3 in March of this year on that initial drop. So if you had pivot points on and you were an investor or a swing trader, you saw that, you put your limit order right here, or whatever, to trigger, you would have made a nice return on that, a nice entry point for investment. Same thing in April, right down to S3. I mean, it held it even. Limit order here, nice return so far. Just wanted to showcase that because, my goal is basically to help investors and traders become more profitable. And I just want to showcase all the tools that I found through my experience and my years in the market to actually provide reliable results. So standard pivot points. All right, next I'll go over some fundamentals because we have a big week ahead fundamentally. This week ahead is going to move the markets. So first of all, we have earnings, right? Last week we had earnings season. We saw Google's earnings report and Tesla's earnings report, which they both performed well after Tesla's report was really bad, but the stock performed well. Google's report was very good, and the stock also performed pretty well. But this week we're gonna have, the major players, right? Meta and Apple and Amazon, etc. So keep an eye out. Just know that we're gonna see volatility this week. In terms of economic news, we have a lot. On Tuesday, we have the JOLTS job openings. Prior, we're at 7.5 million. They're forecasting no change in job openings in the past month. So we want to look to see if we get a report of 7.5 million. Wednesday, GDP growth rate quarter over quarter. This is huge. They're forecasting GDP to drop from 2.4% to 2.4%. Why is GDP so important? Because a technical definition of a recession is two negative GDP quarters in a row. Negative doesn't mean decreasing, by the way. I mean like a negative number, like negative 1%. So we still have not seen a negative GDP reading. All right. So all those people on TikTok who are saying we already had a negative, it's not true, but it's decreasing. It's getting very, very close to negative. So this will be very important. If the actual GDP growth rate comes above this forecast, that would be great news. If it comes below, that would be very bearish. If it comes in negative, wow, that would be bad. We'll see what happens. All right, next, core PCE price index. This is an inflationary measure. Is shown to decrease some more, which is good because the Feds do not want to cut interest rates at the cost of further inflation. They want to see inflation hit their 2% target sustainably, and that's when they want to cut rates. Cutting rates is very important because it stimulates the economy. When they cut rates, debt becomes cheaper. The US can pay back its debt cheaper. Companies can afford their loans more. They can afford to take out more loans, etc., etc. Car loans become cheaper, mortgages become cheaper. People will spend more money. It's stimulation for the economy. So we want to see this continue to decrease. That's good. Personal income, personal spending. Personal income is shown to actually decrease from 0.8 to 0.4% month over month. By the way, these numbers like month over month, it means like, you know, personal income grew 0.8% last month. They're forecasting to still grow, but 0.4% this month. So still growing, but at a slower rate. Personal spending is seen to stay steady. These are important with job openings because the Feds track, they have a dual mandate, right? Keep labor market strong, bring inflation down at 2%. So these two factors are very, very important to them and to us. So we want to make sure that employment stays steady to avoid any kind of fear of recession. ISM manufacturing on Thursday. ISM manufacturing basically shows, basically the way that you read this number, if it's below 50, it shows that industry of manufacturing is contracting, right? When it's above 50, it's expanding. So we have been seeing manufacturing contract. Last month it came out at 49. They're forecasting to decrease further to 47.9. And then Friday we have really big ones too. Non-farm payrolls, unemployment rate. They're both unemployment, like employment related readings. They're forecasting payrolls to decrease from 238K to 130,000 employees. But they're seeing the unemployment rate stay the same. They're forecasting it to not change from 4.2%, which is good. If unemployment rates start spiking, that is very recessionary, like very scary. So we want to see unemployment rate stay steady. So basically this week, a lot of economic readings, you want to see GDP stay positive, you want to see unemployment stay steady, and you want to see inflation come down. Those are three key things you want to look for. So I want to end this video by just saying if you watched up to this point, I appreciate it. I hope you get value out of this. I hope it helps you get your bearings on the market. It helps you formulate your investing and trading plans. I do want to let you know that I do have a free Discord server. It is free. Link is in the description of all my videos. And I try to make this as a resource for investors and traders because I'm both. I'm an investor, but I'm also a trader because things are expensive and you want to have a side hustle, right? Have some extra income to save and to build on so you can grow your life. So my server, I have something called Market Manual, which I post studies like the VIX study that I did, the Death Cross study I did. I post studies in here that are good resources to help you learn. And I'm always open to feedback. I have a feedback channel. I encourage on all my YouTube videos to leave feedback because I want to give value the best way that I can. I want to make sure that I address a lot of people's questions and needs when it comes to stock market. So my trading style is I'm mostly an option seller. I wheel, so I do cash secured puts and I sell covered calls when I get assigned. And I post all my trades live in my server as well. So right when I execute them, I post them here, and every week I have a track record that I show. So currently I'm a 92% win rate, which is great for the kind of market conditions that we've been having. And I post these not for you to copy, but to see like where I set my strikes, how I set my expiries, how I manage my trades, when do I close for profit, when do I close for loss, and it's just as a learning, it's for learning. Um, I also have trade signals that I post, buy signals, sell signals. Again, not obviously not to copy because there's no such thing as a signal that's perfect, no matter what people advertise. But these signals are meant to help you with another checkbox on your swing trading, right? These signals show up on the daily chart. They last for 1 to 2 weeks. They're valid for 1 to 2 weeks. So when a stock has a buy signal and you're thinking, okay, like I think we're bullish in the short term for the next week. I want to take, bullish day trades, bullish swing trades. What stock should I take those trades on? Well, you have a list of stocks that had a buy signal. That means there's an elevated chance of it being strong against the market, elevated chance of higher prices, higher chance of you being profitable on that trade. And every week I post the results of these signals. Most of the time, they're really high hit rates. This week was 88%. Sometimes they're low hit rates, 36%, but majority of the time, 100% hit rate, 100% hit rate, 88% hit rate, 62.5% hit rate. So I like these a lot. I find them very helpful for when I take my option selling trades. I sell options like on companies I want to own and companies that have a bullish trend. Um, Same thing with sell signals, it shows stocks that are weak. You think the market's going to go down, you want to prepare some shorts. What stocks should you prepare your shorts on? And same thing, I post hit rates every week, and it's been really well. 80%, 93%, 100%, 100%. So I just putting it out there is very helpful. I hope to see you in here. It is a growing community. I want it to keep growing, and I want to keep providing good value. So, thank you again for watching. Please like and subscribe, and good luck.